The Hodl tax is another reason to self-custody your Bitcoin. I wasn't aware of this, so I brought in everyone's favorite crypto CPA, Shihan Chandrasekhara, to the show to explain. So Shihan, welcome back.
Yeah, great to be here again.
Before we get into that, can you just give us a quick refresher so everybody knows? First of all, I'm going to ask you this. What is a taxable event? What's the difference between short and long-term capital gains? And then also there's one called a net investment income tax. So just real quick, Shihan, could you just kind of go through like what is an actual taxable event in crypto so people know?
Yeah, so in general for crypto, there are 5 taxable events. By the way, this has nothing to do with the ETF. This is just general crypto. So number 1, just cashing out. Pretty self-explanatory. You had Bitcoin, you sold it for a profit for cash, you got to pay taxes.
Sure.
Number 2, when you exchange one coin or NFT with another coin or NFT, the IRS does not care if you receive cash or not. You still have to pay taxes if that first coin has appreciated in value at the time you're exchanging it to the next coin.
Okay.
Number 3, when you spend cryptocurrency or even NFTs to buy goods and services, that triggers a taxable event. Number 4 is when you earn cryptocurrencies. You can earn cryptocurrencies through mining, staking, employment income, and etc. Those are taxable. The last one is crypto-specific events, like sometimes you get new coins as a result of an airdrop or a hard fork, and those coins are taxed at the time you receive them based on the fair market value. So those are the 5 taxable events.
Gotcha. Okay, so that is just the basics of basics. Let's talk about short and long-term capital gains, because you put this up, and of course people look at this and they're like, what is this? Do I have to pay this much taxes? So just real quick, difference between short and long-term, and what are the brackets here in the United States? Now, of course, we can't cover all the different countries that are out there, but this is a general term, and this is just for the US.
Yeah, so at a high level, what determines whether something is short-term or long-term is the holding period. In simple terms, that means how much you're keeping an ETF share or a coin or a stock. Mm-hmm. So if you were to buy something and sell after holding it for less than 12 months, the resulting profit results in what's called short-term capital gains. And those gains are subject to these tax rates based on your filing status and the income levels. So let's say, for example, you made $50,000 worth of short-term capital gains.
Nice.
So you got to kind of follow the chart. So 50,000 kind of in that third row. So that 50,000 is going to be subject to, assuming you're a single filer, that's going to be subject to a 22% tax rate. So that's kind of how it works.
Gotcha. So from if I make 50,000, not bad. So this is progressive tax, right? So from 0 to 11,000, I'm paying X amount.
Correct.
11,000 to 44,000, I'm paying 12, and 44 to that, I'm paying 22. It's not like when I get to 44,000, I'm immediately paying 22%. So I know some people sometimes have that question, but we have a progressive tax. Now let's talk.
Yeah. So just to clarify, so the 22% the rate's going to be applied to whatever the difference between 50,000 minus 44,725.
Exactly.
Yeah.
Gotcha. Good clarification. So that would be the short term. Let's talk about long term.
Yeah. So the long term capital gains apply when you sell something for a profit after holding it for more than 12 months. So there are 3 tax rates for these profits to be subject to. 0%, 15%, and 20%. By the way, a lot of people are not aware of this 0%, tax rate, and it's something that you can use if you kind of meet the qualifications. Let's do like another example here. So let's say $50,000, like in our previous example. In this case, it's a long-term capital gain. In this scenario, that entire 50,000 is going to be subject to a flat 15% tax rate, because these rates are kind of work a little bit different compared to the previous chart. And by the way, in order for you to get the 0% rate, like your entire taxable income for the year has to be less than like 44,625 if you're like a single person. So let's say, for example, you had 1 year, all you had was $40,000 worth of long-term Bitcoin, stock, or ETF gains. that's going to be subject to 0% tax rate, meaning you don't have to pay any taxes.
Well, thank God for small wonders. Only 40,000 to live on. Yeah.
Yeah, only 40,000 to live on, but if you really think about it, that's probably equivalent to a $65,000 W-2 income, right? Because you're not paying taxes. Like if you have like a 62,000, 65,000 W-2 job, your actual cash inflow is probably going to be somewhere around 40 to 45,000. Like that's actually what hitting your bank account. So
that is very true.
Yeah.
Yeah, I could be okay, living around $3,700 to $4,000 a month, just going from there. I mean, of course, it'd be 48,000, but yeah, let's just say 35. I can do that. So there's that piece. Now let's talk about the NIIT, the net investment income tax. What exactly is this here?
Yeah, so we spoke about short-term capital gains and long-term capital gains.
Yeah.
And in any given year, if your total income, but as a matter of fact, it's called the modified gross adjusted income, exceeds any of these thresholds, you had to pay an additional 3.8% tax on top of your capital gain tax. So going with our example before, so you had $50,000 worth of, could be short-term or long-term, but for the entire year, you made like, $500,000 because you're high net worth individuals, and that $500,000 could come from wages or business income or whatever. So in that case, that 50,000 is subject to the short-term or long-term capital gain taxes we spoke about, plus this additional 3.8% tax.
Fun times. Good. I love taxes. So now that'll leave us to our last point, which is one that I had a question on, which was these fund expenses, because this is all from the Bitcoin ETF and the different institutions that are offering those services, the BlackRocks and the Fidelities and things like that. There is a fund expense. So could you kind of walk us through this? Because that's for the people who right now are going, okay, I'm just going to do a Bitcoin ETF, but I haven't sold anything. So how does this work for fund expenses?
Yeah, so this is somewhat unique thing to spot ETFs, because these ETFs are structured as grantor trust. So obviously, like sponsors like ARK and Fidelity, they need to have money to kind of run their fund, right? They had to pay the salaries and etc.
Right.
In order to do that, they have to dispose of like Bitcoins throughout the year to kind of come up with the cash inflow. So whenever they do that, that results in a capital gain or loss event for the shareholders, because whenever you spend something like Bitcoin, there's a difference between how much you paid for it and the market value. So if there's a profit, there's a gain at the fund level. And as the ETF shareholder, you had to report that gain based on your pro rata share of the fund that you own. But the trick here is that you had to report that gain, but the fund is not giving you the cash. They're not distributing that.
Yeah.
So I like to kind of call this like a hodling tax, because generally speaking, like,
a good one.
hodling is completely tax-free. Like if you're holding, Bitcoin, or even like any stock, right?
Right.
But if you're hodling a spot Bitcoin ETF fund, you had to pay this tax. That's kind of something for you guys to know about.
That's crazy. That's crazy. So everybody, if you're new to the game and then you're saying to yourself that an ETF could be very safe, of course you offload some of those restrictions and the things that you have to do as far as what you're holding on to it. That is true, but just like Shihan said, and I've never heard of this until right now, there is a hodling tax. That is probably what I will use in the description and the title for this actual video. So Shihan, that's interesting stuff, and yet another reason why I think people should learn how to self-custody and cold storage devices, but that's another video. So Shihan, before we take off, any last words of wisdom for the people out there getting into the space right now?
I think the spot Bitcoin ETF, there are legit use cases for using something like that, especially if you want to buy, if you want to have exposure to crypto in a 401k, SEP IRA, or any type of retirement account. The spot Bitcoin ETF is a really good way to go about that. But if you want to hold Bitcoin for the long run, the cheapest way for you to do is self-custody. Assuming you don't lose any seed phrase and stuff like that, or you don't compromise your seed phrase to a hacker.
This is very true. There's always the pros and the cons. So Shihan, thank you so much. All right, everybody. So look, if you like today's video, give it a thumbs up, consider subscribing. If you want to follow Shihan, there's information below in the description. That's it for today. So everybody, thanks so much for stopping by. Hope this helped. and we'll see you in the next one.
Thanks, guys.